retirees and soon-to-be retirees, welcome back to the Monolith Money Show, the place where we discuss everything related to financial well-being in your retirement. I'm your host, Camille Butterfield, and today we've got a crucial topic on our hands. Are you paying too much in taxes during your golden years? Well, fear not, because we're diving into how a retirement income analysis can help you blunt the tax bite in retirement. Taxes, a necessary evil in our American lives. They pay for roads, safety, and a whole host of other community-related services. We enjoy the benefits of our taxes that they pay for, but we loathe the idea of paying more than our fair share. Taxes even follow you into retirement. Those retirement accounts you started drawing from, Social Security benefits you're receiving, and other income from accounts designed to support your lifestyle in retirement may be taxable. For most of your working life, you've been in the accumulation phase, or gathering and growing assets to be used to support you in your later years. During retirement, however, you move to a different mindset as you transition into a distribution phase, or the spending. Planning for the distribution phase does include a shift in perspective as you work towards preserving the assets you spent so many years building. One of the keys to preserving your assets is to really develop an appropriate distribution strategy, one that accounts for many things, including the taxes you're going to owe in retirement, and answers the key questions: when should I start taking income from my accounts? Which accounts should I take the income from? A distribution strategy is designed to create a plan for optimizing your tax liability and your income, and maintaining that income for as long as you are going to need it. Even if you've already entered into retirement, you can still benefit from a distribution plan and potential repositioning of assets to help ensure your tax strategy is as tax efficient as possible. While distribution planning would start before retirement in an ideal world, people who have already entered retirement can also greatly benefit from building a distribution strategy to potentially pay less in future taxes. But where do you begin? What steps do you need to take today to help ensure financial confidence tomorrow? An experienced financial professional really can help you develop a tax-efficient approach designed to preserve your retirement assets, whether you're already retired or you plan to work for 10 or more years. All right, let's get into this. Many people think that retirement automatically means you pay less in taxes. After all, you're no longer being handed a paycheck from an employer, right? The reality is that most Americans don't reduce their tax bill that much in retirement. What's the reason? You're still taking an income, but you most likely have fewer deductions and credits than you had during your working years. Retirement income can come from a variety of sources, both taxable and non-taxable. Whether or not the income is taxable does depend on the source or what account you take it from. The potential key to optimizing your taxes and putting more money in your pocket is to blend your income from a variety of sources. Here's a look at which accounts are going to be taxable and which ones are not. Let's start with taxable income, those qualified accounts. Most retirement accounts, including 401ks, 403bs, simple IRAs, SEP IRAs, profit sharing plans, pension plans, and traditional IRAs, are what we call qualified accounts. Qualified accounts are designed for retirement income. Any money saved into these plans can be accessed without penalty after the age of 59 and a half. The IRS has allowed money in these accounts to be saved and grow tax deferred, meaning the taxes have been delayed until some point in the future. You haven't paid any taxes on qualified retirement accounts yet. So when you start to take income from these accounts, taxes are owed at ordinary tax rates at the time of distribution, meaning they're subject to 100% taxable income. So beware, because you haven't paid any money in taxes on this yet, the IRS, well, they're soon going to be calling for what is due to them. This typically starts at age 73, where you have to be starting to take a forced annual distribution or a required minimum distribution, RMD, from a qualified account. That amount is calculated based on your age, the amount of money in the account, and life expectancy factor. If you don't take an RMD, you could receive a tax penalty of up to 25% of that RMD amount for that year. So a lot of times it helps to just put those on automatic, or just you don't have to think about those distributions. Social Security. Will your Social Security benefits be taxable? Honestly, it depends. So to avoid being taxed on your Social Security benefits, we have to look at all the other income sources. Check out this image right here. This shows you how much and when your Social Security is taxable. Non-taxable income. Annuities. Annuities are another type of account designed to provide income during retirement. Unlike more traditional retirement accounts, not all income from an annuity may be taxable. So it's really going to depend on a variety of factors, including what type of annuity is and how it was funded. Like, is it an IRA? Is it non-qualified? Or is it Roth? So not sure if your income from an annuity might be taxed? A financial advisor can review your existing annuity and help clarify. Consider this. In your younger years, you probably took advantage of a wide range of tax deductions and credits. That's great. This may have included a child tax credit or expenses for your child care. You also may have taken deductions for the interest you paid on a mortgage or student loans or work-related expenses you were able to write off. However, because of changes brought by the 2017 Tax Cuts and Jobs Act, it is likely that fewer taxpayers will actually itemize. You're no longer to claim certain deductions on your taxes, such as personal exemptions. The federal government has changed its itemized deduction rules related to work expenses as well. As a result, deductions may no longer exist or may have significantly changed. Even if you do itemize, some of the allowed deductions may no longer work for your situation. Maybe you've paid off your house and loans, which means you can no longer deduct the mortgage interest on your return. When you meet with a financial advisor, you can review the accounts you currently own, and they can provide you with an understanding of how income from each account might be taxed. They also can introduce you to a qualified professional who is experienced in taxes. But don't wait. It's important to meet with an advisor now in order to put an effective plan in place from the beginning of your retirement. Tax laws are ever changing. Just when you think you've got your tax picture figured out, the IRS and Congress come along and mix things up. Changes in the tax law can drastically impact your retirement income, leaving you to make critical lifestyle adjustments. While changes to federal tax laws might have been the biggest impact on your bottom line, you might also be affected by modifications to your state and local tax codes. These could also take a bite out of your income. An aging American population is creating a new set of variables for tax professionals, making it a little bit more difficult to predict how future tax liabilities may affect retirees. Increasing national debt, projected Social Security shortfalls, and increased Medicare expenses, including costs related to healthcare and long-term care, may drastically affect future codes. But never fear. It's not necessary to become a tax professional to understand how possible legislative changes could impact your bottom line in retirement. It is necessary, however, to work with a financial advisor who understands how to build an income strategy that accounts for those possible changes and helps you take the necessary steps to be ready for them when they come. So listen, where you put your money, it does matter. Different types of accounts have different tax statuses: taxable, tax deferred, and tax free. And while many Americans have money earmarked for retirement, often that money is stashed in a variety of accounts started at various times throughout their earning years. The accounts may not work together to provide an income stream that works effectively for tax purposes. The categories move from 100% taxable to 100% income tax free for you and your estate. So in preparing a plan for retirement income, your financial advisor could make recommendations for how much of your assets should be allocated to each type. If you currently have money saved, you may need to consider redistributing some of your existing assets into different categories. Maybe you might want to consider a Roth IRA. Eligible taxpayers under the age of 50 can contribute up to $7,000 in a Roth IRA in 2024. Over 50 can contribute an extra 1,000 or 8,000. You won't receive an income tax deduction for your contribution, but your money will grow tax-free. You can also withdraw the contributions tax-free at any time after you reach the age of 59 and a half and the account has been open for at least 5 years. Withdrawals will not be taxed at all, and you don't have to convert all of your funds to a Roth IRA. Partial conversions provide some flexibility in how much you pay in taxes today. We call that bumping your head on the top of the tax bracket. Because converting a traditional IRA or other qualified assets to a Roth is a taxable event and could result in additional impact in your personal tax situation, including but not limited to a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, higher taxes on Social Security benefits, and Medicare premiums. We always say consult a qualified tax advisor before making these decisions regarding a potential Roth conversion. Please keep in mind that due to recent tax laws, it is no longer possible to undo a conversion through recharacterization. It is generally preferable that you have funds to pay the taxes due upon conversion from funds outside of your IRA, so like a checking or savings. If you elect to take a distribution from your IRA to pay the conversion taxes, please keep in mind the potential consequences, such as an assessment of product surrender charges or additional IRS penalties for premature distributions. Giving to future generations. When planning your estate, you might want to consider the funds you plan to gift before your death, as well as the money you wish to distribute after you're gone. The types of accounts that can help accomplish these goals might include life insurance, accounts set up for minors, funds to be given to charitable organizations, and money designated as gifts to loved ones. In 2024, the gifting limit is $18,000 to an individual each year without triggering a federal gift tax consequence or having to file a form. So how much should you have in each category? Well, that's all really going to depend on you, your goals for your retirement, how much you want to leave to your heirs, and so much more. And that's where working with someone can really help devise a strategy customized to meet your personal needs. Planning for retirement income, it's going to start with a plan. And that is for optimizing taxes in retirement, a tricky situation because it is difficult to know what the future might hold. They can also work with qualified professionals such as a tax accountant or estate planning attorney to really help implement all the tools to make your strategy efficiently and effectively work for you. But you're not going to want to wait. It is important to start now to help make this strategy work in the future. Is this information helpful? Give us a thumbs up, subscribe to the Monolith Money Show for more retirement insights, and hit that notification bell so you never miss an update. As always, I'm Camille Butterfield, wishing you a financially secure and tax-efficient retirement. Thanks, and I'll see you again.